Okay, welcome to my own FP. In this video, we're going to take a look at more aggressively melting down our RRSP by using some of our rules that you can manipulate to see how your scenario reacts to different planning scenarios. So let's take a look at those rules. And first we're going to do is copy our scenario. So we're going to take the CPP 71. We're going to copy that. We're going to set the new label on this. We're going to call this MTI 2024. MTI means what we're going to try to do here is use a MTI rule in our additional income, which is Minimum Taxable Income. And so we just abbreviate it to MTI 2024 because that's the data that we're using. So let's save that. And then we're in our MTI 2024 scenario. So we have various rules in the system. Desired saving rules are rules that you want, or for things that you want to contribute, typically to registered accounts. So I don't have enough. Maybe I have some amount in my gross, but maybe I don't have enough in my gross and I need to take some from our RRSP. So in previous videos, sometimes we had to take some out of cash because we didn't have enough to contribute to our TFSA or our RRSP. So, or I had to take some out of our non-registered account and transfer that into our TFSA or RRSP. If you don't have RESPs or tax-free first home savings accounts, then those will just be null and void there and won't be used. So we're going to leave all these at the defaults. Basically, we're going to contribute still 100% of our room to our TFSA. For our TFSA account, it says our yearly contribution room. This also includes any withdrawals from the previous year. So this is new room in the new year. So it isn't, if I had $100,000 of old room and I took out $10,000 in the last year, then this year I would get $10,000 plus my $7,000 that I have for the next year. It does not include the old contribution room that still might be available to you in this particular case. So this is the yearly contribution, which is the new room for that year. Surplus savings, we're also not going to change any of these. And what these are is if I have a lot in gross and I pay my taxes and I pay my liabilities and various payments on those, and I have some money left over, then the first thing I'm going to do is in this case, we're going to take all of our contribution room from the TFSA. I'm going to take whatever I have, I'm going to put everything into my TFSA of my total contribution room, not just the yearly. And then I'm going to transfer any more money that I have after that to my cash account, and I'm going to try to limit that cash account to $100,000, and I'm going to inflate that in increments of $5,000 over time. If I still have more money left over, I'm going to transfer it to my account that's named non-registered. And then if I still have money left over, which if you had a non-registered account with that name, there won't be anything left over because it's 100%. And then if you didn't have that account, then it would be to a non-registered account. And so this will go to your first non-registered account alphabetically, and it'll put all the money into that account first. So typically, if you don't have a non-registered account of that name, you might want to come and modify your rule to make sure it goes into there, especially in some cases, if you have cash as your first thing, then this last rule will also go into your cash, which might not be what you wanted. So we're going to leave all that as it is. The system automatically takes into all gross, all things that are taxable or occurring within a given year. So employment, CPP, OAS, GIS, inheritances, things like that, things for your defined benefit pension plan, your annuities that might happen. If you have dividends or capital gains or income in a non-registered account, it'll put those into gross. If you have a RIF or LIF or RRSP or defined type of plan, then any minimums from your LIF or RIF, once they're converted to those, would automatically go into gross. So that gives you a bucket of money. And then if we need additional income, beyond that amount of money to satisfy our expenses, or we just want to take more out to create more of a surplus, then these rules are what are used. So we have money, we looked at our expenses, and we then evaluate how much more money do we want to take out after that. So, and for these rules, if you had LIRA, DCP accounts, which both are LIF accounts effectively in the end, once they're converted, then we're going to take 100% of the maximum withdrawal amount from those LIFs once they're converted. We don't have them in our case. So in this case, we're going to withdraw up to 10% of the value of our RRSP accounts. So we're just, each account, whatever it is, we're going to take 10%. And then it's up to that based on the amount of requirement that we have. So how much of our expenses? If my expenses were only $1,000, but 10% would be $10,000, I'll only take out $1,000. There's a within the rule, you can say, no, I want to take all $10,000, or you can say up to that value. So those are a couple different options. If we don't have money in our RRSP, or we've that after that 10%, if we still need more money, we're going to sell some of our cash account or non-registered accounts, and then we're going to withdraw from our TFSA. So that's what the default rules are. We're going to modify. The only one we're going to modify is our RRSP rule. From our RRSP, we're going to take from our personal RRSP. We're going to use a minimum taxable income, and we're going to say $60,000. And we're going to inflate that yearly based on 2024. So starting in 2024, we're going to try to get to a minimum taxable income. If our gross account already had $60,000, then we won't take any money out of here. If it was at $58,000 and we needed $2,000, then we'll take $2,000. If it was at $40,000 and we need $20,000, then we'll take $20,000. So as you manipulate your CPP or OAS in different years, or taxes change, or not taxes, but different income comes in, then this will automatically adjust to get you to try to get at least $60,000. If there's more than that, then we won't use this rule. Okay. And then one of the things we're going to do is, since Mary and Harry have very similar account values, we're just going to make sure that they use all the same rules. If you don't, you have to either edit both rules for both people. The reason there's different rules for different people, maybe one person has, $3 million in accounts, and the other person has $100,000 in accounts, and your rules would want to be quite a bit different in those situations. So Harry's going to use all the rules. So if you look at Harry now, once I submit it, we're going to edit that again. And then if you look at Harry, so Harry uses all the rules from Mary. Okay. So, and then we're going to make this from 2025. Okay. So those are the years that we're going to start doing. So now that we have our rules set up, we can run the scenario. MTI 2025. Okay, so we're 2025 year. This is how things work out. You can go through the different scenario. You can see that we're much more aggressively dropping our RRSP all the way at age 80. It's done. So, which will be kind of interesting if I look at our estate. After that, we're paying no income tax on our estate after age 80. For Mary, I think Harry's going to be very similar to that. So at age 80, our RRSP is basically at zero, and we pay no estate tax. So that could be what you want. And when we're going to take a look and try to compare and understand, is this scenario and this set of rules better than the previous set of rules? So, okay. So let's take a look. And let's take a look quickly at gross income. Oh, sorry. What we want to do is do the comparison of these. So we're going to go to here, and we're going to go CPP 70, MTI 2024. You can compare the inputs, the grids, and we're going to look at gross income. So you can see here, let's do this in joint, $2024. And you can see the RRSP in the old case on CPP at 70. RRSP went all the way out to 95 with a very small value. Here, we're taking a lot more out in all the way from 2029 through 2047. So a couple things that are to point out here are the non-registered. See, we're taking very little non-registered in these cases. This will just be basically the dividends and capital gains that are required for taxes. In this case, we took a little bit out of either cash or non-registered in these years. So this allows, taking more out of our RSP allows your non-registered to live a little bit longer. We still took some out from cash and non-registered to buy our cars in these cases. In this case, we took some out of our RSP to buy the car. That's not going to happen in this case because in this case, we're limited to taxable income of $60,000 to buy our car, for our gross income or taxable income. So in these cases, our non-registered accounts get used, or even possibly, in this case, our TFSA might get used in this case as well, which it does in the other case as well, once our non-registered goes to zero. Okay, so this will end up with a much flatter tax rate, at least up to 24/7, and then it'll very quickly end up at a very low tax rate as you get into your, whatever year this is, 86 or something like that. You'll end up with a almost zero tax rate. So whether that's good, whether that's bad is a question. Let's look at our tax rates, as I just talked about. Okay, so we're still paying 5% tax. That's basically just going to be your CPP and OAS combined, probably, I would expect. But we're paying more tax here because we're taking more out of our RSP because we didn't take as much out of our cash or non-registered account. So that's a question. You were paying a little bit extra early and you're paying less later. This one is more balanced all the way through, despite the spikes for the car sort of thing. But we could manipulate that in another way to get the not out of our RSP as well. So we can definitely do that. But it's kind of interesting to sort of show that we don't actually have to pay that much tax. Now we're 9.5%, now we're 12%. So it's not that significant, but the reason for that is, we're paying very little tax if we live beyond 80, sort of thing, which could be good. So let's take a look at the comparison accounts, or comparison charts, I should say. And the bottom one is always what I find the most interesting. So it's a bit of a mixed bag, as you can see. If it's positive on the top, especially for residuals or assets and things like that, then that is going to favor the minimum taxable income of $60,000. If it's on the lower bottom part below zero, then it's going to favor the initial scenario, or the CPP at 70 scenario, which was just using a simpler RRSP rule. So let's take a look at our estate residual. So again, remember, we're looking at a $9,000, a $9 million estate. Let's just quickly do our joint estate residual. Okay, so at the end of the day, the CPP at 70 wins out if you live to 95 by $80,000. So, but this is again $9 million. So let's take a look at understanding what that relative thing is here. So let's look at, let's say, residual, and you can see that we are between $25,000 and $30,000, either negative or positive. So it favors one or the other based on how you're taking out certain money. So that's not very much relative to the estate at this point, which was, I can't remember, 75 or something. It's $5 million roughly. So this is really insignificant relative to the whole thing. Sure, you're up by a little bit, you're down by a little bit on this side, and then this aggressive RRSP meltdown ends up being slightly negative towards the tail end compared to the previous option. So a lot of people would look at it and go, yeah, we definitely, if I have money in my RRSP, why would I want to take money from my non-registered? Sometimes that balanced approach is a slightly better scenario, and everybody's situation is different. You have to look at all your different account values and understand what that might be. Just in this particular scenario, it's kind of interesting that it's negative for a little bit, positive for a little bit, negative depending on if you both pass away at that sort of age. Okay. So let's look at our TFSA. So as the line starts going up, that means we're contributing more into our TFSA, and so we're hitting a much higher peak in the MTI case with our TFSA. Once it starts on the downslope, that means we're in the MTI case, we're taking more out of our TFSA in those cases. Your TFSA is still more, but since it's now on the downslope, that means that we're taking more out of our TFSA in each of those years. And as we get towards 93, 94, we actually end up with slightly less in our TFSA in this case, in the MTI case, than we had in the default case, which was CPV at 70. So it's interesting that in the earlier years you could actually you had enough money to add more to your TFSA in the prior example. So let's look at RRSP. The first year we have additional RRSP room. That's because we didn't take the RRSP to buy our car in that year, and then we were actually more aggressively taking down the RRSP right away. Right after that first little bump, as that downslope happens, that means we're taking more out of our RRSP every year, all the way down to around 2047, 2048. And that's where we bottom out, and we actually hit zero at that age. So once we hit zero, then in the MTI case, we're taking less out, and therefore the line starts increasing. It's going to converge to zero anyway in all cases, because we're trying to drive the account to zero. So we're not taking anything out in the MTI case. We were taking some out in the CPP case, so that's why they converge to zero. If we look at the actual RRSP in the upper graph, we can see that we'll take the other lines off, and we can see that at 24/7 we have a steeper line, and then at 24/7 we're not taking anything out anymore. So that's where that line starts increasing again, up to converge to zero. So we're taking out a lot of RRSP room much more aggressively all the way along. We had that initial little first bump because we didn't do the car from RRSP. The MTI case is useful. You may still want to use it. It doesn't, if you look at your overall estate residual between the two, doesn't make that much difference. You might sort of say, well, since I have a much better TFSA in the one case, maybe that's actually the better approach anyway, and not worry about it. So you could also then say, well, let's not drain our RRSP by age 80. Let's maybe, if we drain our RRSP by 2052 or 2053 at age 86, maybe that ends up being as a slightly better strategy. If we want to take a look just quickly before we go, let's do our saving income rule. Let's see if we can extend it out a little bit. So if we edit this, and let's do this one at $55,000. Let's just see what that would actually do at 55. And we go to scenarios. Let's compare that and that. And let's look at our estate residual. So in this case now, our RSP goes a little bit longer, actually right to about 86. And the MTI case actually ends up negative at first by $12,000 and positive near the end by $20,000, and then going lower and then recovering a little bit again. So again, you're a $9 million estate, and this change made it go different by, any given year, or estate is going to only really be different by $10,000 to $20,000, positive or negative. Our TFSA up until 95 definitely wins out. If you go longer, it will definitely go below. Our RRSP, we took less from our RRSP because instead of 60, we did 55. So we were taking less from our RRSP. So we think we have more in our RRSP going forward, which makes sense. And then obviously once we hit a certain point, it's all drained. So, okay. So we can see quickly here. We did it bang on at 86, and that slope, especially in these years, ends up being relatively the same, and then much better curve going here. Obviously, we were taking a lot more out between 79 and 86 to really try to drive that down so I don't end up with a bigger tax bill. But yes, you will end up with a bigger tax bill, but at the end, the actual residual of your estate between before tax, after tax, by the time you end up after tax, it ends up being slightly positive in almost all cases for the MTI at 55. So let's do one more thing, taking a quick look at our gross income. And let's do this joint in 2024. And you can see here that the RSP continues all the way out to 2053. Before, in 2053 is age 86. Before it was age 80 or so it would have dropped off here. The biggest difference here is now we're taking more a little bit out of our non-registered accounts just to sort of top up stuff from our RIF. So keeping your RIF going a little bit longer, taking a little bit from non-registered might help out. We sort of supplemented, we lost our non-registered, but we still needed a little bit of money, so we used our TFSA a little bit here just to sort of compensate for that. So that's quite useful to have, sort of thing. So it can be, you can play around all you want and try to figure out what the rules are. Take CPP at 68, take it at 70, do this and that. The end up final estate, in this case, it ends up not being that much different. It could end up being quite different. Depends on what your overall estate value is and what the account distribution is between all the different values between your different accounts. So the idea here is take a look at the rules, figure out what makes sense for you, what you're happy with. Maybe people are not so happy if they have to take so much out of their RRSP early, or maybe they're super happy if they want to take it out early and concentrate only on getting CPP and OAS and TFSA later on. So those are options for you to take a look at, and we'll leave it at there. We're going to revert this back to 60, and then we're going to update with 2025 values and see how that compares. Okay, so thanks very much. In the next video, we're doing as I just said. We're going to update to 2025 values, and then we're going to compare that against the 2024 scenario and see how we've made out. Thanks very much. Thanks for watching. Bye.